Good morning, traders. Today is February the 14th. My name is Neville Hornsey, market analyst for trading, and today I'll be taking a look at the week ahead. Okay, I'm going to try and keep this relatively brief because essentially we have got some tier one data scheduled in on the calendar. A lot of it is to do with the FOMC. A lot of it is to do with inflation type stuff. So just have a quick scan. Today, US session, FOMC member Bullard speaking. Could be announcing an emergency rate hike, who knows? But we do also have ECB Lagarde speaking soon after. So we need to take a look at the euro versus US dollar. If you just scan through all the way down to Friday, there's FOMC members speaking, Waller, Brainard. You know, it's FOMC meeting minutes on Wednesday. So this week is going to be heavily around the US dollar. What happens to the US dollar will then affect the euro, the Aussie, the Canadian, and things like that. But it all becomes irrelevant, essentially, you know, if the US and Russia, NATO, Ukraine, if that really kicks off this week, it's just going to be a massive move into the safe havens. You'll be looking at stronger yen, stronger US dollar, stronger Swiss franc. So just taking a look at the YouTrading.com Forex heat map, already you can see there's a big move into the Japanese yen. Swiss franc also very strong, only weaker than the yen. US dollar, again, really strong. Only the yen and the Swiss franc are stronger. So there's already a big move into the safe havens. That means equities, commodities, the Aussie, the New Zealand dollar, likely to go lower. Canadian, you know, if there's a massive disruption to oil supply from Russia because of some sort of incursion or sanctions or anything that happens along those lines, I don't think OPEC themselves are going to be able to pick up the slack. So Canadian dollar is probably going to go higher, as is oil. But that all depends on what happens in the news and geopolitics. In terms of what's actually going on at the moment in the markets, US markets, you know, if you just look at the Dow, the reason I'm looking at the Dow Jones is because on this USA industrials, this CFD here, 82% of traders on this platform are trying to go long, and I just think they're going to get absolutely squeezed out. There's nothing bullish about this at the moment. Technically, fundamentally, there's lots of flows going into the US markets from the federal government. There's increased bank lending. Unfortunately, there is high inflation. Jobs was obviously picking up NFP. That was good. So fundamentally, if there wasn't a possible war and increasing high inflation, you know, that I would be looking to sort of buy the dip. But at the moment, technically, market structure, this is looking like it's going lower. So I've put on the Andrews pitchfork. If you just go to the lows and the sort of most significant highs, then the median line here, if it was just like a straight sort of elevator down, would be at 33,500 at least. But obviously, it's going to sort of have a gradient to the slope. So I can see 33,000 getting tagged, which is not good. Looking at the US index for the dollar, if I open up this chart, you can see that we've cleared the sell-off from when ECB President Lagarde spoke back here, beginning of February. We've carried on going higher since NFP. Obviously, we had a break of market structure that formed on the 8th of February. So we broke that on the 10th of February, big pullback into the NFP sort of imbalance, found support, and now we've gone higher, which means today I'm going to be closing out this euro versus US dollar. It came down almost to the tick, or to the pip, if you like, of where I wanted, 1.13. 1.13 got defended. Unfortunately, I didn't get filled on this short because of spread. So I need to just manually close that out now. Obviously, this is just a demo account. I'm not really expecting to make all that money. It's just for illustration purposes only. Looking at the Australian versus US dollar, like I said, US dollar is going higher, so commodity is going to come lower. Australian dollar is going to get affected. I see this as a bear market. Now we've taken out this sort of market structure here from the 11th of February. If that holds, 0.71 holds, then we're going to come down, test this liquidity, possibly come down now and down to 0.69. So going back to the economic calendar, like I said, Wednesday, even for the week, if scheduled news is the way the market's going to play out and it's not geopolitics, then FOMC meeting minutes on Wednesday is the sort of focus. But we obviously have crude oil inventories. That's going to be probably market moving for oil. Retail sales also in the US, that's market moving if that comes out better than expected. Pound get affected by the CPI year over year. Obviously, everyone's expecting that to come in at 5.4%, which is the same as previous, but could quite easily be a lot higher. Thursday, employment change for Australian dollar, probably going to come in exactly the same for the unemployment rate. And then if you look here, got fully fed manufacturing for the US dollar, but we also have G20 meetings starting on Thursday, continuing through Friday. So for me, Thursday and Friday is just a complete write-off. Too many people speaking, essentially, market would be choppy, unless, of course, something mad happens over towards Ukraine and we have a big sell-off. So I'm just going to trade, what I'm seeing the flows do currently up until Wednesday, and then I think I'm just going to leave it. So going back to active trader, dollar CAD, there's obviously some intraday resistance above, liquidity above these swing highs. I think we can easily get through that as the US dollar goes higher. If we just skip down to Brent, 65% of traders are trying to short this now. Obviously, a bit of a sell-off this morning, but the trend is clearly to the upside. We tagged this sort of inside channel, if you like, for the actual wider pitchfork. Could get a little bit of a pullback if we just zoom a lot closer in. What I would suggest you all do is obviously start on a higher time frame, so the daily, and then look for where the previous highs are. Generally, they get tested. So you've got this high here from the 10th of February, hasn't been tested quite yet. But if we then go down to, say, an hour intraday chart, you can see, there you go, that's that swing high. We want to sort of see this breakout candle here get taken. But if you look at this swing high from that intraday sort of breakout, that has been tested. So essentially, any imbalance that was created from the breakout has been filled in now. If you look a bit lower, there's not anything else to take out apart from the $90 level. There's like a little gap here between this high and this low. So it didn't quite come down, fill this imbalance. So $90. If we get through the 92.50s, I'll be looking for 90. But I think from what you can see here, making higher highs, higher lows. So I think we'll go higher in oil, which would be good for the Canadian dollar, but only if the US dollar index comes down. Obviously, we've got this imbalance here from earlier this morning, London Open. Might get a pullback in the US dollar index as it's taken out this liquidity up here. And then, depending on what happens in geopolitics and the scheduled news, we've got the breakout at 96. And then we've got also this imbalance here. We had like a big push up on the 11th of February from the 95.70s. So we could come back down and test that. But, the algos like to fill in all of these data points. Just be aware that we've taken out this swing high here and we could get a reversal if they want to sort of stick within this range whilst they're working out what happens with Russia. If we go higher, if this becomes support, then take out these liquidity above these swing highs, come up to the H4 resistance, $96.80, good target before we start pushing up towards the weekly resistance and 98. Right, that's kind of it really. I think we just need to be on our toes. You need to have a look at an economic calendar. You need to be aware of the FOMC members and then this G20 stuff at the end of the week. FOMC meeting minutes probably cause the market to slow down as we approach it. Just be nimble. Probably best to only pick your A+ trades this week and on a smaller position size, keep your risk low. All right, good luck, and I'll speak to you again tomorrow.